Nio Inc., New York Stock Exchange, NYSE, symbol NIO, price at $5.58 USD, change plus 0.18 or 3.33%, market status closed, data from last trading session. The market is currently closed. Nio Inc. ended the last trading session at exactly $5.58, pushing upward by 18 cents, which translates to a 3.33% gain for the day. In the after-hours markets, we have seen this momentum quietly continue, ticking up further towards the $5.64 mark, suggesting that traders are positioning themselves aggressively before the opening bell. When you look at the intraday chart, the stock opened near 545, dipped to a low of 527, testing the resolve of the bulls before staging a high-volume recovery to close near the highs of the session. This isn't just a random fluctuation, it is a calculated coil tightening ahead of what could be the most significant week for the company in 2025. Expectations right now are undeniably heavy, almost suffocating. The general consensus on Wall Street, the chatter you hear on nearly every online investment forum, and the sentiment reflected in the put-call ratios suggest that Nio is backed into a corner. The narrative is that European Union tariffs are going to strangle their margins, that the cash burn is unsustainable, and that the company is simply another hardware manufacturer caught in a brutal price war with Tesla stock and domestic Chinese rivals. That is the expectation, a slow bleed into irrelevance. But the reality, when you strip away the fear and look at the actual operational maneuvers occurring over the last 48 hours, is startlingly different. The reality is that Nio is no longer just selling cars. As of this week, they have officially begun licensing their proprietary autonomous driving chips to external clients, fundamentally altering their valuation model from a pure automaker to a technology supplier. This is a structural pivot that the market has not yet priced in, and it creates a divergence between price and value that we need to examine with a microscope. When you watch the order flow on platforms like Interactive Brokers, you usually see a clear distinction between retail capitulation and institutional accumulation. Right now, despite the gloom in the headlines, we are seeing the latter. The bounce off the $5.30 support level on Friday was not an accident. It was a technical defense of the 200-day moving average, a line in the sand that long-term funds defend when they believe the downside risk is capped. While the average retail trader on Robinhood stock trading apps might be looking at the 6-month chart and seeing a downtrend, the smart money is looking at the imminent Q3 earnings report scheduled for Tuesday, November 25th, tomorrow. They are positioning for a volatility event that could shatter the current trading range. Let's talk about the immediate catalyst that is driving this 3% move. It is not just the broader China stimulus package, although that provides a nice tailwind. The specific driver here is the confirmation that the Onvo L60, Nio's mass-market challenger to the Model Y, has hit a critical delivery milestone. We are looking at data indicating 20,000 deliveries achieved in just 100 days. To put that in perspective, it took many legacy automakers years to ramp up EV production to that level of efficiency. The Onvo brand was dismissed by critics as a distraction, a dilution of the premium Nio brand equity. However, the reality is that Onvo is acting as a massive volume funnel, absorbing fixed costs and allowing Nio to penetrate the sub-$30,000 market without tarnishing its luxury status. This is the exact strategy that Tesla stock employed with the Model 3, but Nio is doing it with a unique twist, the battery-as-a-service or BOSS model that lowers the upfront sticker price significantly. This brings us to the elephant in the room, the technology transfer. News broke over the weekend that Nio has signed its first external licensing deal for the Shenji NX9031 autonomous driving chip. If you follow NVIDIA stock, you understand that the highest margins in the world are not in bending metal or assembling chassis. They are in silicon and software. For years, Nio has been pouring billions into R&D, a line item that bearish analysts love to criticize. Why are they spending so much, they ask, just buy chips from NVIDIA? But now we see the payoff. By licensing this architecture to other automotive semiconductor companies, Nio is creating a high-margin revenue stream that is completely immune to EU tariffs on vehicles. You cannot tariff a licensing agreement in the same way you tariff a physical car entering a port in Rotterdam. This is a strategic masterstroke that hedges their geopolitical risk, yet it is currently absent from most mainstream analyses you will find on investing sites. The market psychology here is fascinating. We are sitting at $5.58. The 50-day moving average is looming overhead at roughly $6.95. This creates a technical gap. If the earnings report tomorrow confirms that revenue guidance is hitting the 22 billion RMB range, we could see a gap-up scenario where the price bypasses resistance entirely. Conversely, if they miss on margins, the bears will try to push this back down to the $5 psychological floor. It's a high-stakes poker game. Investors using Fidelity investments or Fidelity mutual funds are likely seeing this volatility and wondering if it is time to cut losses or average down. The answer lies in your time horizon. If you are trading the weekly swing, the risk is massive. If you are looking at the 2026 profitability timeline, the current price represents a valuation that arguably assigns zero value to the battery swap network or the new chip business. Let's talk about that battery swap network because it remains the singular moat that Nio possesses. Critics have long argued that battery swapping is too capital-intensive. They say, look at Tesla stock. They abandoned swapping for superchargers. However, the grid infrastructure in China is different, and the consumer behavior is different. With the launch of the Firefly brand, the compact EV designed for urban environments, the swap network becomes even more critical. Firefly is targeting a different demographic, one that likely doesn't have home charging. For them, a 3-minute swap is the only viable option. We are seeing data that Firefly deliveries are tracking to exceed October's records, with over 30,000 domestic deliveries logged. This suggests that the ecosystem effect, similar to what you see with Apple stock, is beginning to take hold. Once a user buys into the Nio ecosystem, using the Nio phone, the swap stations, the Nio house, the switching costs become very high. However, we must address the geopolitical friction. It is the dark cloud hanging over the stock. The European Union has moved forward with tariffs that effectively raise the price of Nio's exports. This is where the expectation of failure is most concentrated. Investors read tariffs and assume no sales. But the reality is nuanced. Nio's management has been very deliberate about their European strategy, focusing on leasing models and subscription services which can sometimes navigate around the direct import duties, depending on how the asset is classified. Furthermore, the expansion into the UK, which has different tariff structures than the EU post-Brexit, provides a relief valve. When you're looking for investment help or using tools like Schwab Intelligent Portfolios to balance your risk, you have to weigh these geopolitical headwinds against the company's ability to pivot. Nio has shown a level of agility that is rare for a car company. They are not just sitting there accepting the tariffs, they are reshuffling their supply chain and their market focus to mitigate the damage. Let's look deeper at the institutional activity. In the last quarter, we saw a rotation. Some of the weaker hands, the momentum funds that chase quarterly beats, have exited. In their place, we are seeing accumulation from quantitative funds and ETFs, including some Fidelity ETFs and SoFi ETFs that track emerging market tech. These algorithms pick up on divergences. They see a company growing revenue at 40% year over year, as projected for Q3, trading at a price-to-sales ratio that is nearing distress levels. The divergence between growth and valuation is what attracts the interactive brokers crowd, the sophisticated traders who understand that at $5, the option value of Nio just surviving is worth more than the current market cap implies. If you are engaged in self-investing or managing an individual brokerage account, you need to understand the liquidity dynamics of this stock. Nio is a high beta name. It moves with the Nasdaq, it moves with the Hang Seng, and it moves with the Chinese yuan. Recently, the correlation with the broader Chinese tech sector has been tight. As Beijing announces stimulus measures to prop up the property market and consumer spending, Nio acts as a leverage play on the Chinese consumer. If the Chinese middle class feels richer, they buy premium EVs. The recent stimulus announcements have put a floor under the stock, preventing it from crashing through the $4 level during the worst of the sell-offs. You often see this dynamic discussed on Robinhood crypto forums and stock threads, where